Okay, let's get going, guys. Thank you for joining us. Today, I have the great pleasure of speaking with Charles Edwards, who is the creator of the hash ribbon indicator that, you know, quite a few of us posted about recently because it flashed green as a buy signal for Bitcoin. Now, this has been historically a very reliable indicator for future gains to come. It doesn't mean it's an immediate buy and the price will rocket up immediately, but it's a pretty good indicator of what's to come in the near term. Charles, welcome to my spaces. Really appreciate you making the time.
Great to be here, Archie, Bitcoin Archive. Thank you so
Yeah,
much.
appreciate it. Hey, look, I know you've been around quite a long time, but you're fairly low profile and you don't seem to live your life on Twitter like the rest of us. Can you give us a bit of a background on who you are, what you do, and how your involvement in Bitcoin as well?
Yeah, sure thing. So I'm the founder of Caprioli Investments, where we run a quant crypto fund. So primarily trading autonomous algorithms against Bitcoin is the bulk of it, and some against other cryptos. But yeah, so I got into the space into crypto really in 2017. Kind of caught my attention, unfortunately, a bit late, I thought at the time, but I quickly obviously dug into Bitcoin and the other assets and just realized it's going to be a huge space and opportunity, and just pivoted all of my kind of investment related research and trading algorithms towards that. And yeah, that's basically what I spend my time on for work, is focusing on trying to identify different areas of value, whether it be undervalue or overvalue in Bitcoin and the crypto markets in general, to navigate this incredibly high returning asset.
So, what gave you conviction to pretty much go all in career wise towards Bitcoin and all the other stuff that you trade?
Probably it kind of comes back to the really basic arguments of the value of Bitcoin and money, and just kind of the more I dived into that rabbit hole, and I you know the Bitcoin itself, we could talk about this for ages, but it's in my opinion still really the only truly decentralized crypto asset. The others have varying levels of decentralization, and they all have their own. Well, not all of them, but many do have their own value proposition, which I think is valuable too. But for Bitcoin, it's that decentralization and just rock solid future pathway of incrementally less inflation over time, which can't be manipulated. And it's been brewing the last 5, 10 plus years, and just becoming obviously out of control the last 2 years, but inflation in general and in fiat currencies. So yeah, I just saw that as just being essentially the future of money, and then the tech layer of other assets within crypto as well, just having a huge place in the tech finance world.
So I had a couple of traders recently on my spaces last week, Tone Vase and also Sven Henrik, who is Northman Trader. You might know him better as Northman Trader.
Yeah.
And I was interested in how do they make the distinction between their trading portfolio and do they have a hodling portfolio? Like, how do you approach that aspect of it with respect to Bitcoin? Because you've just spoken about the properties. You're obviously an admirer of the properties of Bitcoin, but you're also professionally a trader. So how do you sort of reconcile the two, and how do you manage that from a personal perspective? And perhaps then you can tell us a little bit about your professional life as well.
Yeah, good question. I've never had that one before. So I do maintain, a portion of. Obviously, the first thing is you got to manage your kind of outgoings in your life and your tax obligations, etc. So all of that, obviously, I'm pretty conservative with in sort of a cash perspective. And then I do have a portion which I just hold in kind of Bitcoin, because I just see it as a great long term kind of no brainer. But the vast majority of my assets are then in our fund. So in the Caprioli fund, because I do want to try and navigate the cycles and try and minimize those 85% down draws that happen every few years. And I think that's the best way for me to do it. Obviously, this is not advice for anyone else, and you need to for Bitcoin or any asset, make your own assessment decision. But yeah, so that's the probably rough split, I suppose, for me.
Yeah, that's really interesting, because when I entered this space, I thought I probably would trade on the sort of medium to longer term cycles. But this thing that I'm doing now has turned out to be so much bigger than I could have ever imagined. So it's taking up a lot of my time, and I've just realized that, you know what, I should just probably focus on a different strategy. And I've shared that a few times before, which is basically, if I can generate an income, I'm happy to hold through the ups and downs, which is interesting to talk to you, because your focus is to navigate the ups and downs. And
Yeah.
the question I've got now is, well, everyone seemed to be sucked into the misapprehension that, you know, the past 3 cycles would somehow repeat a fourth time. Did you start seeing some warning signs earlier than the price action indicated, and what were they?
Yeah, look, good question. This cycle was a bit different. We didn't get to the levels of overvaluation I think pretty much every on-chain analyst expected. And that kind of typical blow off the top or just higher acceleration of prices. So I think, yeah, I really, coming into 2021, so start of last year, I really expected we'd see at least 50K. Like, I'd be shocked if that didn't happen, but I did kind of expect we'd get close to the 100K mark. So that was surprising. We didn't get to that level of overextension on a lot of those on-chain readings. So in terms of navigating it, in hindsight, probably could have done a bit better. That's always going to be the case, I think. It's a game of probabilities, and you do have to kind of expect, especially any investor. It doesn't matter how you're doing it or trading it. You have to expect a level of down draw. The past is never going to be exactly the same as the future. New data becomes more relevant at different times. So yeah, it's a game where you have to be, if you're going to try and navigate it or trade it, it should probably be a full-time job, or you're better off just doing the long-term buy and hold situation, in my opinion, because it's a rapidly evolving field which does need a lot of attention to keep up with.
I have to confess, and I've said this a few times, I was fully expecting the double pump, you know, on that second leg of the bull market when we went up to 69. I thought we were ready and primed to shoot up at least to test 100,000, but it didn't eventuate. And in hindsight, I know a lot of people, well, not a lot of people, one or two people were calling for the Wyckoff distribution taking form, but I think a lot of us were so busy looking up and expecting the price to go up, we didn't notice any of that at all. And in the end, it turned out to be almost a near perfect Wyckoff or Wyckoff. I don't know how the distribution chart. Did you pick up on that at any time before it actually happened?
Yeah, that's a good one. So I am a bit of a fan of Wyckoff, just for my own sort of self-interest, not actively, I suppose, for the fun. But with those kind of structures and patterns, so it's effectively working out, the Wyckoff theory is basically working out when are the institutions accumulating and when are they kind of selling, and how are they manipulating the market to do so. And with all those kind of structures, at least in the process, you kind of need to wait for certain confirmations. So it's kind of like a basic head and shoulders or a triangular pattern. You can kind of see it forming, but unless it confirms and you get the sort of neckline breakout, or for Wyckoff, a kind of a breakdown in the lower structure for a distribution, it's not confirmed. So a lot of people call it and say it's happening or it's forming, but it's hard to actually actively trade that until you get the confirmation. So I think, don't quote me on the numbers, but I think that for me, I wouldn't have called that confirmed until around sort of 45K region, when we had that kind of consolidation and breakdown of the Wyckoff structure. So when we're at 60, I don't think that was as useful there. But yeah, there's definitely other sort of hindsight telltale signs, and funding was extremely over the top there. So a lot of people were leveraging long. We also had on-chain metrics which were not matching with price, like address activity, for example, was kind of declining since the sort of May 2021 bottom. It never really picked up and saw growth. So there are a few other signs there. But yeah, it's kind of with all these things, you're never going to get 100% confluence of data points and metrics. You have to kind of weight them, and based on whatever you think is the most important, make a decision off those. You never really get everything lining up. So it's, a tricky thing to do part-time, that's for sure.
Oh, yeah, for sure. You mentioned institutional funds, and I want to get into that a little bit later on. But while we're talking about the structures, I think your recollection of the price confirmation of the Wyckoff formation matches mine, because I remember it was around about in the 40s when it became popularized on Twitter, and people started pointing to how eerily similar the distribution structure matched the ensuing price action as well, the chart. And there was a few videos on Twitter breaking that down, and a few people saying, look at me, I called it in advance. And there's always a few of those, but I found it quite eerie how well it matched that. And I wonder, do you attribute the abnormal shape of this cycle, we didn't get a blow off top, do you attribute that to anything in particular?
It's one of those things with investing and trading in general. I think the longer a pattern plays out, the less effective it becomes, but just because people start manipulating it or going against it, or it gets overtraded, for example. So, for example, in traditional markets or equities, in the 60s, 70s, and early 80s, momentum was the best strategy, or maybe not the best, but it was an incredibly profitable strategy. But the results of kind of simple momentum strategies then really dwindled for the next decades, and just more complex strategies started to work. And it's kind of similar, I would say, for Bitcoin. It's a young asset, but it's maturing at a much more rapid rate than anything we've seen in the last 50 years. So if everyone's looking at the same metrics or data points, they often start to work a bit less. So lots of people looking for a blow off top, so obviously didn't quite happen. That said, it is a great technical asset if you're just trading sort of pure price action, purely because so much of the world still doesn't really understand Bitcoin and how to value it. And it's kind of like an ongoing intellectual debate of what is the value of Bitcoin and crypto, because it's not an equity. There's no ownership over any assets technically behind the product. So it's because it's such a debate on the value side, the technicals have worked quite well. So that's why you see things like horizontal lines and sort of Wyckoff structures work reasonably well. But every time is always a bit different. So it always rhymes a bit, but it's never going to be the same as it was before.
Because I recall the sentiment at the time, there were NFTs in the sector going off, and that was quite crazy, and stadium naming rights. But I didn't feel at the time that we were at the peak. It still felt like, okay, we're getting going now. It's starting to heat up. That's what it felt like, and it felt like it just kind of bubbled at that level for a while and then just fizzled out. I didn't sense that the market was really hot, and perhaps I'm a little bit biased because I'm so immersed in the ecosystem, the media as well. But did you sense that things were just getting a little bit too crazy for Bitcoin? I know some of the other stuff was a bit crazy because it was also new, but did you feel that Bitcoin was overheating at 60s?
Look, I on a personal level, I felt similar to you, that I just expected it to do more. I on a cycle kind of basis, I think it was pretty underwhelming last year. But the other factor, I guess, is that there were so many new product branches and categories coming out in this cycle that already attracted and sucked in a lot of capital. Like you just mentioned NFTs, which were huge last year, kind of like a whole brand new asset class where a lot of capital flowed to try and either invest or get a quick win, right? So I think that sucked a lot of the momentum out of something like Bitcoin, and probably is why the upside was a bit more constrained. And that, it's not just price-wise, it's also fundamentals too, because if less people are using that network and because they're trying to get advantage of something else, then obviously everything kind of caps out a bit lower. But yeah, it was strange. And also the China ban probably was a big stunt and everything. Just that came out kind of right in the middle of the bull run year.
Yeah.
And just sucked the air out of a lot of stuff. So I think that also probably diminished things that year.
So I wasn't around in 2016, 17. Did you catch much of the ICO craze? And do you think it was similar in sentiment or in terms of, how hot the market got to what the NFTs did in the retail space?
Yeah, it was similar, I would say. I wasn't around for all of it, but most of 17. The difference I would say is that back then the infrastructure was so limited. So there was there's no, like, people weren't using MetaMask and stuff like that, and all the trading pairs were Bitcoin denominated. So if you wanted to buy a new, ICO, or you wanted to just trade an altcoin, you had to kind of go via Bitcoin. So that kept a relatively high volume, I would say, in Bitcoin. Whereas now, obviously, you've got half a dozen or more different stable coins. You can use a whole bunch of different chains, or you can just trade straight off dollars on most exchanges. So there was less necessity to interact with Bitcoin. So I think that probably, again, also made it a bit different in terms of the flows that Bitcoin saw, at least.
So when you look at the price chart of Bitcoin right now, do you still think that it's going to adhere to, in a roundabout way, the previous 4-year cycles? Do you think it's, the market has broken past all of those things, or do you think that they will still hold somehow?
I think they'll still hold with diminishing effect in subsequent years. So because every subsequent halving has a relatively small impact in terms of the block reward, so to speak. So, and also now that the inflation rate of Bitcoin is basically equal to gold, so the lowest inflation kind of asset in the world, every halving from there doesn't give it an incremental advantage, so to speak. So the cycles will probably have a diminishing impact. But that said, I think it's still very relevant right now. As we've seen, it has more or less played out. It just didn't go probably as high as most thought last year. And it's right now, it's on track to a normal cycle. So in terms of timing, we're in year, for the halving cycle, obviously we're in between years 2 and 3, and every prior cycle, that 1 year window marked the exact cycle bottom, and we're in that window right now. So for me, it's kind of like a trifecta. We have these 3 elements of really deep discounts in value of on-chain metrics right now. We have that just pure timing where we are in the cycle. Years 2 and 3 has always marked the bottom of it. And the Bitcoin halving cycle has been basically the crypto industry clock, in a way, like the master clock. And then in terms of just pure drawdown, we see 80-85% drawdown every 4 years or so, and we've reached 90% of that already. Now, Bitcoin's volatility has been reducing significantly over the years. It's much less than it was 10 years ago, and it's generally trending down. So while we can obviously go lower and we can hit those kind of 80-85% down draws, it's not a necessity. So for me, 90% of the way there is a big tick in terms of opportunity. So yeah, those 3 things: timing, just value discounts, and down draw, just make this a really incredible long-term opportunity if you just look at the crypto industry alone.
So there are a lot of people who are very active on Twitter still calling for, very low teens to 10K. Do you see any merit in that based on the analysis that you do?
Yeah, so yeah, the more people that have that opinion, I think the less likely it becomes, at least in the near term. So when I think about where we are and how low we can go, I'm kind of weighting in my head all sorts of different things. So technical, so price. I think 20K is obviously an incredible support, but we're currently grinding sideways against it, which in my experience, when we hit a support a few times and then go sideways there for too long, it usually ends badly. um, but then there's the on-chain stuff, deep discounts. It can go lower for sure, but we also have signals like the hash ribbons, which is just fired, like you mentioned at the start. That is currently in about a 6.5% down draw from the signal going green, which is well within normal ranges. So as you mentioned, the hash ribbon signal can take a while to play out. The average kind of down draw from it going green for the first couple of months is about 15%, or what it was a couple of years ago. I haven't checked recently, but give or take, it's normal to expect some down draw. And then obviously you have the talk of the day, which is the macro environment, which is all wild and wacky ever since Corona, and now obviously this big tightening cycle, war in Europe, and possible energy crisis. But the other thing to think about there is that with the macro side of things, it again can always go lower. And if it does, if stocks go break new lows, I'm sure Bitcoin will too. But we do have an insane amount of negative data points and sentiment in the market over the last months. And that's usually what you see when you get value opportunities in the market. And in terms of the Fed kind of interest rate regimes, that they do drive a lot of the big macro market cycles, and it usually marks the turning points when the regime actually changes, when the policy changes. So we've already, the last Fed speech, Powell obviously came out very hardline, but we have started to see some indication that rates will probably not rise as aggressively into the future. And
what are some of those?
Yeah, exactly. So the best one, or not maybe not the best one, but a very good one is just the 10-year Treasury rate, which is basically what the market is forecasting those rates to be. And it's come down actually the last couple of days. It's in just over 3%, but it hasn't broken a new high in 3 months. So everyone's freaking out about everything. But the fact is that the situation in terms of rates and expectations of the market for rates is basically unchanged in 3 months. So just that's why I think the market overreacted with the Fed's speech a couple of weeks ago, and just obviously we lost a bit on risk assets then. But effectively, there was no net change yet. If the 10-year does break out a new all-time high, I think it's above 3.4% or so, then that picture will change quite quickly. But just looking at the data today, it's not there. So I think there's a bit of an overreaction on that side. And as soon as that kind of stance does change to either just not increasing as aggressively or just holding current rates, I think risk assets will rally from there. But yeah, we could talk about this stuff all day. Even the Russia stuff is an interesting kind of chess game playing out, which is at the moment seems like a lose-lose. So it doesn't make sense logically. I don't know how much you can say Putin's logical, but it doesn't make sense logically for this to play out for that long. So yeah, there's a lot of negativity, which for me is also opportunity. And I guess our job, and all of our jobs, if we're investing in the space, is not to try and time the exact bottom, because you never will, but to just try and get high confluence or high probability investments or trades. And for me, we're seeing a lot of those signs right now, and I think they'll probably continue for some time, for the next months. And yeah, these bottoms do take a while to form. At least the Bitcoin cycles, they're kind of like a U shape. They can go sideways for a long time. So there's no urgency, but I think this, like now and the next months, is just a huge opportunity.
So I'm wondering, because the Fed is quite obviously adamant and very hawkish about what their intentions are. But maybe some of that, or a lot of that, is signaling to the market rather than what they will end up doing. Because let's not forget how quickly they changed their minds about inflation, and they were in denial for so long, and then suddenly, they acknowledged it and kicked into gear. Too late, I might add. So they're hawkish. The news is universally bad. I mean, bad news is ubiquitous these days. It dominates the narrative. Most macro analysts are focused on high gas prices, impending rate rises. It seems that the doom dominates, and you just wonder, is it all priced in? I know it's kind of a trite question to ask, but if is it time to be counter-cyclical and to say, well, maybe it's all been priced in, maybe it's not going to get that bad? Or, I don't have a read on it, so I'm interested in your view on that.
I broadly agree with you. I wouldn't want to like bet my life on it and say, you know, everyone's doom and gloom, let's go all in, because again, these especially in equities, if we think crypto bear markets last a long time, equities bear markets can last many years. So I wouldn't go and bet the house on it, but yeah, there's so much doom and gloom right now. The opportunity does seem skewed to the upside, and you have to also consider that how people think, and it's scientifically proven that we value or we weight fear and loss twice as much as we weight any gains in financial circumstances. So, and that's obviously why fear is such a seller on the news, right? And it's also why when fear is at really extreme levels, it's often a great time to get into the market. And you know, those levels do fluctuate from week to week and month to month, but the last few months they've been pretty out of control in equities.
Michael, speaking of betting the house on it, Michael Burry has certainly bet the house on it. He's pretty much sold all his equities based on his last filing, except for one, which is kind of, I guess, a prison operator, which doesn't say too much about what he expects to happen in the States. That's a kind of Mad Max scenario to me. It's like, it's out of hell. So I'm like, okay, yeah. You have any comments on that? Because he seems to think that we're at just, you know, it's the first leg of the equity drawdown and the worst is yet to come. If that happens, I don't think anyone can doubt that, you know, Bitcoin and crypto in general will also go down further as well.
Yeah, look, he's obviously got an incredible reputation and story. So I wouldn't want to, you know, go toe to toe with him on that subject. I think, you know, he's in a different game. So he's in equities. If rates are rising, and I'm sure I think he's been out of the market for several or many months now. So that would make sense to hold that kind of position until he sees a change in direction. That's one element. The other element I would say is that has probably a pretty negative outlook on a lot of things, as you mentioned, based on just being in prisons at the moment as well. And most economists and investors that play the bear side heavily or more, you know, significantly more aggressively than the you know, the bullish or positive side, long term, they've pretty much always lost out. So yeah, I you know, that obviously that mentality can work very well in the short term, but if long term, it's it's a bit of a question mark. So yeah.
Let's talk about the hash ribbon. It's I guess the thing that you're most well known for. And how did you come across that indicator? And can you tell us, for a lot of people who are listening, perhaps who haven't delved into it, what is the hash ribbon? How do you derive the indicator, and what is the meaning of it when it crosses over?
Sure. So I created that metric in 2019, and it's basically a way of trying to identify, you know, major bottoms or cyclical bottoms in Bitcoin, and based on supply side dynamics of Bitcoin miners. So especially when I created it, and still relevant now, but a bit less so, is that miners dominated the network. Obviously, back then the block reward was double what it is now. There were no institutions. It was just retail traders and miners basically in Bitcoin, and they had the vast amount of, you know, treasuries and influence in the network. They're still very powerful today, but it's just a bigger pond now with institutions and the like in there. But essentially, when miners were in trouble, and today when they're in trouble, it had often marked major bottoms. So back then we didn't have a lot of the platforms we do now, so the data opportunities were a bit less. But I was trying to identify ways of valuing or timing the market, and one of the most readily available clean data feeds was hash rate. So supply side, demand side metrics were a bit more lacking or a bit more random, I suppose. So I focused in on supply side, looked at hash rate, and found that it often collapsed near the major price collapses, and when it started to recover, it marked the kind of more the bottoms in the cycle. So Which kind of makes sense, because if Bitcoin miners are struggling, if the price is getting, the price may come down 10, 20, 30, 50%, and so their profit margins are getting squeezed, and Bitcoin miners all around the world have really varying setups, varying electrical prices. Even things like today with Europe and electricity prices going up, that's going to have some impact as well. But the less efficient miners, the ones with higher rates, the ones with worse hardware, etc., they will really feel squeezed sooner. They'll start losing money if the price drops low enough. And at some point, they have to decide, okay, do we just turn off our hardware because we're burning so much electricity? And they may either go out of business, or they may mine something else or do something else with their hardware. But at that point, the financial stress is so high that they'll often, obviously, as well, be selling their treasuries. They're selling Bitcoin. So a lot of miners have this attitude, and it was interesting to see that at Bitcoin Miami this year, that they just don't sell their Bitcoin, they just accumulate. And that obviously works well in the bull market, but when things kind of get bad, like now, they get like double hit. And that's why I was saying a few go out of business. So yeah, so when they start selling and struggling, it just collapses down the price, and Bitcoin, you hit some kind of floor where you're left with the most efficient miners, and a base kind of builds out, and then eventually hash rate starts to climb again as those those better, efficient, more operators grow. And when you see that improvement aligned with also positive price momentum, I found that just identified pretty much all the major price bottoms, obviously within a volatility range.
So it's like it gives an indication of whether or not the ecosystem is being flushed out from weak miners who've had to sell, and whether or not there's going to be forced selling from them. Do you think, given the block size or the block reward has diminished so much since the earlier days of establishing this metric, do you think the effectiveness of the metric will be affected by that as well?
Yeah, so I do. So your response is correct, and I do think its effectiveness will reduce. I still think it's valuable today because all of the live signals to date have been incredibly useful for me. And I still think this one signal that happened a week or two ago is relevant. That said, with every halving, so obviously we'll have another one in 2024, and then every 4 years from there, the relevance does diminish, and it kind of plays into that, how I said the whole halving cycle in general will probably have less of an impact in the long term. So in short, yeah, I think it's very useful today, probably less useful than 4 years ago, but much more useful than in 4 years, where in 4 years, maybe it won't be useful at all. It's hard to say. So as with all these things, you want to obviously weight how much you use it based on whatever you think the value is, and your risk tolerance is, but also consider confluence with other metrics and data points. So for us, we do weight hash ribbons quite highly. So it is resulting in a slightly net positive allocation to Bitcoin at the moment. But we're also seeing a vast array of other fundamental metrics, which, while they're at deep value regions, they're not trending or growing in the right direction. So we're not fully allocated, so to speak, right now. But that can change very quickly day to day, and it does do so. So yeah, it's for me, it's still the most powerful bottom signal. I might change my mind in a couple of years, but right now it is. And it does provide confluence. So while there are other big factors at play, like we've seen these huge institutions and funds collapse, liquidate, go bankrupt, 3AC and various other lending platforms, etc., all this stuff tends to happen at similar times, right? The stress hits everyone, and obviously we've now seen the capitulation for miners happen at basically the exact same time that all those entities blew up.
Yeah.
Which is quite fascinating. So it's for me, it still provides that value in a quantitative way.
So I'm looking at a number of, previously very reliable bottom indicators on chain. So like the MVRV is, the Z-score is still in the green zone. But when I switch over and have a look at the entity adjusted dormancy flow, that's like broken right through. It's like, what the hell is going on there? We've had 4 4 different times where it's just bounced off the green zone, you'd think, oh yeah, that's enough to give me some confidence, right? And it's just gone straight through that. I don't know what it's digging for, but it's still going down, and it's actually trending even lower still. So, okay.
Yeah,
so my question is going to lead
to. Sorry, go ahead.
So we've had a number of events, with on-chain, and the first thing that sort of kicked it off was when our good friend Willy Woo shut down his newsletter, saying that, on-chain analysis, I don't have the confidence that I can provide the value that I was previously. And then, I've spoken to other analysts who've also brought to light the fact that a lot of these transactions by hedge funds and institutions are undertaken off-chain because, they're provided by various market makers off-chain, and they've got bespoke services and whatnot. And so we don't actually get to see the true movement of coins and the true volume of coins because they're not reported as such. This is not a regulated industry, and we don't see the full volume and activity on chain like we used to. So my question to you is, on the value of on-chain analysis, do you still see the value there? I gather you do see some value because you're trading on it still, but what has been your observations of its effectiveness over the last 2 years?
Yeah, great question. So I'll step through each of those. So yeah, there's a lot of really valuable on-chain metrics in short, and they do provide tradable, investable insight, in my opinion. So things like MVRV you touched on, and dormancy. So dormancy looks horrendous. It looks like it's going to zero. But that's the problem with some of this on-chain analysis is you see those charts and people are just drawing almost random green bands on them and said, okay, when it gets here, you buy, and when it's here, you sell, because there's 2 other data points where it hit that level and it was a great time to buy. And that's the problem with a lot of the on-chain analysis you see on Twitter is people look at 2 or 3 or maybe 5 or 6 data points and they make a decision based on it, and everyone gets behind it. This is the time. But that's not how it works. It's not, you cannot quantifiably, you cannot have a statistical view of value by looking at it that way. So the other thing, I think that did, to be fair, that did work better and easier when there weren't institutions in the market 2 or 3 years ago.
I think they've messed everything up by the sounds of it. Sorry, I'm interrupting your flow. Go ahead.
No, yeah, it's a valid point, but I don't think they messed it up. I think they've just brought complexity and more rigor to the game. So you can no longer just look at a single metric or even 6 metrics, draw some horizontal lines on them and say, okay, these are saying buy, so it must be the bottom, or let's buy. That's just not how these guys invest. You need to apply a more scientific, rigorous process to it. So for example, we have a macro index strategy, which is a machine learning model applied to over 35 different on-chain and equity traditional data points. And every day it's reweighting all of those metrics and their levels and trends and growth and various different factors to determine a net position based on that. So it doesn't even look at price. It just only looks at what I would call fundamentals only. And it basically adapts and learns which metrics are better over time or more recently and reweights them. So I think that's the level you have to be on if you want to really take on-chain investing seriously now, because it's no longer, the game stepped up. You cannot just trade off charts with like 5 indicators anymore. You're heading against much more sophisticated strategies nowadays.
Do you find that the derivative market or the options futures markets plays a more significant role these days and gives more telling indicators?
Yes, so that's another good one. You could talk about the whole story of derivatives in crypto and how it started back in 2016 or so with BitMEX. That was an incredibly profitable strategy for 2 or 3 years, just trading off funding rates for futures. Like, it was literally 100% hit rate. I've never seen anything like it before. And it was incredible until basically everyone found out about it, and then it wasn't anymore because everyone was doing the same thing and tweeting about it. And so that's one example of the evolution of trading and how it's such a competitive field. You have to constantly be improving more or less. But yeah, it has changed. I think it's added liquidity for short side, long side leverage. It's added a lot of liquidation cascade runs that have been quite famous in Bitcoin in the last 4 years. And it's given institutions an ability to get into the field in various ways, and that's, we could talk about that as well. As it's not just about counter trading or using existing strategies which diminish their impact, but it's what people are using that for. So futures, for example, we saw the big arb trade, or the net neutral trade of cash and carry last year, where institutions were happy to make 40% with relatively low risk. And just that impact and algorithms automatically going in and out of the market based on how high the funding rate was to arb that diminished the impact of that signal as well quite significantly, where now you see funding rates just net negative or very low for months and months on end, and yet price continues to go down. So yeah, these players, and everyone's got a different agenda or a different objective. It really also depends on what either these banks or funds or what have you are trying to achieve, because not everyone is like a Bitcoin maxi or wants to outperform Bitcoin like us. Some people are just happy to get this low risk yield, or everyone's got a different strategy and concept, and all of that kind of blends and mix into what you see in the data. And that's why reading the data is a bit trickier today than it was, say, 2 or 3 years ago, when you just had only retail people who were, either Bitcoin maxis or just looking to trade altcoins, for example.
Do you think that, I guess, just the theory is that NFTs distracted or diverted funds from retail into Bitcoin, and the derivatives market diverted funds from institutions that would otherwise have gone to Bitcoin?
Yeah, I think there's a bit of that. I think it's also a part of the adoption timeline. Like many or most institutions are still skeptical or scared or don't really want to touch crypto and Bitcoin. I think we've seen a huge improvement in that in the last 2 years, obviously, where there's so many banks and institutions in it in some level.
Have you had any personal experience of that? Sorry to interrupt you. I think it's a really important point, because a lot of us, we don't really have relationships with institutional investors. Have you had any touch points with institutional investors on that point? And have you noticed a change in the last 2 years that you could share with us?
Yes, so that's a good one. So the first change was just the headlines, where you saw, big classic banks and traders like Renaissance Tech and different funds jumping in, Druckenmiller, etc. And then obviously Michael Saylor, and then the balance sheet stuff. And you just saw last year, it was just like every month there was a new bank or a new fund setting up in crypto. So that alone was the big sign. But more interesting for me on a personal level is that last year, obviously there was a ton of retail interest, but in the last 3 to 4 or 5 months, say, the number of contacts and inquiries we get from institutions and funds has just gone through the roof, like 10x. Whereas the retail interest is basically almost more or less died. So that in itself just talks to kind of the Wyckoff theory for me on a personal anecdotal level, right? That the institutional interest is very high right now. And if you read just in our newsletter, we do a short news summary of the capital raises in the space, and the biggest crypto fund ever launched in August, $1 billion. So absolutely massive. And if you read the short articles associated with those raises by each of the CAOs and etc., they're basically saying they see a fire sale in crypto right now, and they're all just trying to jump in. Now, as with everything, those sales and those discounts can get deeper, but I just expect that allocation rate to continue quite aggressively in the next months.
So speaking of the newsletter, it's what prompted me to reach out to you and invite you on my spaces, actually. And in particular, the institutional allocation that you mentioned. Can you tell us a little bit about what you're seeing, without, I guess, divulging sources and specifics about who's doing what? But what gives you confidence that there are funds flowing and allocations being made into Bitcoin? by
Yeah, well,
institutions? Yeah.
it's the inquiries we get, but also just the headlines that you see, the 100, 300, 500 million dollar fundraisers literally every month in on the block or any other major crypto outlet, Financial Times, etc. So there's a lot of capital flowing in. The other thing is, it takes a while for these institutions to get into this space. So there's definitely a big lag. They don't know how to hold it. They don't know how to custody it. They don't know if it's legal. They don't know if it's going to get regulated in their stuff. So it takes many years for them to get in. A lot of research, board reviews, etc. So pensions is a good example. We hadn't seen effectively any pensions get into crypto and Bitcoin until more or less this year, and now we're seeing massive pensions get into and invest in crypto or have some allocation into crypto. And these are the massive players, right? These are multi-billion dollar entities that they might just put 1% in, but that 1% is much bigger than what we would get through many retail investors. So it takes a while for it to all flow through. So you have that element of just their internal business process to get into the space. And then you also have the element of them, I would argue, seeing great value in the market if they're here to hold it for many years, that it just makes sense now into the coming months to allocate.
So you mentioned that there's an increasing rate of inquiry from potential institutional investors. How would you describe their organizational posture in approaching you? Are they just inquiring? Are they ready to go? Are they ready to allocate a little bit, a lot? And what do you think is getting their interest in the space? What's motivating them?
Well, I think the big motivator is what everyone sees, which is the incredible returns that Bitcoin and crypto has delivered. It is the fastest growing sector category in the world the last 10 years. Bitcoin alone, 200% average annual returns. And even when you risk adjust those returns, it's the highest performing risk adjusted asset out of everything: real estate, commodities, stocks, etc. So that's obviously the attractive part. These players don't just dive in all at once. It's a journey. Like I said before, they have to do their due diligence. They kind of gradually get in. But as I said, even if it's a 1%, those numbers are massive. So yeah, I think they see that this industry is not going anywhere. It's got incredible future ahead of it, even if we have some tough times like now. So if you want to get in and lower your potential downside, I think that's why they're probably looking at it at the moment.
So people who are looking at Bitcoin right now and wondering whether or not they should buy or should they wait and see if it goes lower, how would you what advice would you give them on navigating that risk reward sort of decision?
Yeah, it's a tough one. It really depends on your timeline and objectives. And it sounds boring, but the fact is that all the arguments and debates you see on Twitter are more often than not people saying, oh, it's going down, it's going up, or you're wrong for this reason or that reason. It's more often than not that each of those people has a different time horizon. One of them may be trading on a 5-minute candle or for 1 hour with a tight stop loss, and the other may be trying to allocate their capital for the next 10 years. So that's the first question. Ask what you're looking for. And of course, as with all this conversation, again, my personal opinions, nothing is advice or financial advice. But from my personal perspective, if I was looking to get into Bitcoin and hold for 5+ years, which I think would see a great return over that window because you capture a full cycle, I think now is an incredible opportunity. And I think actions speak louder than words. So we've, as a company, increased our investment in our fund by double in the last 2 months. So we are aggressively allocating, and I expect to continue to do that next month. And this bear market could go for a long time, but if you want to try time everything perfectly, you'll probably miss, in my opinion, a lot of the opportunity. So it really depends who you are and what you're doing. If you're a day trader, none of this information is probably relevant for you because you're looking, as I said, at those low time frames. You've got your own process. And at the end of the day, as I said earlier, it's all about what is the net probability of the data you look at. So, yeah.
Charles, are you up for some questions and comments from the audience? Shall we open it up for 5 or 10 minutes and see how they go?
Sure, happy to do it.
All right, guys. So if you've got a question or a comment for Charles, put your hand up, and hopefully I can see you, and I'll bring you up for a quick chat. And where are you from, Charles? Do you mind if I ask?
Yeah, I'm from Australia and living in Berlin. Married to a German here.
I was about to ask what took you to Berlin. Okay, so get the setup.
Love took me to Berlin.
Oh, that's as good a reason as any, I think. All right, so who have we got? Thomas, why don't you go ahead?
Sure. Hey, can you guys hear me?
Yeah, we can hear you just fine.
All right, I'll go. I joined a little late, but thanks for holding this. And I was just wondering, from a more like, I guess, I don't know how people think of financial models around crypto, other than like very simplistic, plan B stuff. So my question was sort of, how do you think about all the liquidity that's come out of the system in this sort of downdraft? So like the Celsius 3ACs and the Voyagers of the world, and all the liquidations around loans, with LTVs being broken and stuff like that. Do you think about that when you think of bottoms, or when you just think of price prediction for crypto?
Yeah, absolutely. More from a qualitative personal perspective, it just kind of adds a lot of confluence. So the collapses we've seen in the last couple of months are typical of Bitcoin. This one happens to be obviously bigger. Each one always gets bigger, but liquidation runs and just absolute destruction and bankruptcies. Those events do happen in Bitcoin every 1 to 2 years. So the next obvious example is March 2020, when just everything melted down. There was a huge liquidation cascade from basically $10,000 Bitcoin to $3,500. So it does add confluence, because when you see that maximum pain, in my opinion, it often marks the bottom, because at some point you've got no sellers left. And also the people selling at that point, they don't usually want to sell. They're being forced to sell because they've either got margin calls, or in Bitcoin they're just being liquidated by the exchanges. So and bankruptcies like 3AC, right? They didn't want to sell, but they had to. So at that point, who's left to sell is the next question. So when bottoms they can be formed by new demand coming in, but more often than not, in my opinion, they're formed by a lack of new sellers. So new sellers will happen, if you have a new trigger event, like if equities go down 50% from here. Obviously, that's another reason for new sellers, but that's the not my base case, basically. So those events, they do really provide a high confluence. And for me, there was just so many signs of capitulation the last 2 months. That's also another reason why I'm quite comfortable in allocating more at the moment. But yeah, as with anyone getting into crypto, you have to go in with the mindset, I have to be comfortable that there could be a significant downside from here before I see improvement. But yeah, it's just trying to weight those probabilities.
Cool. Thank you.
Thanks, Thomas. Sandy, unmute your mic and we're ready for your question or comment. Go ahead.
Great. Can you guys hear me okay?
Yep, perfect.
Hey, Charles, I don't know if you heard this news, but Liz Truss was just elected PM of the UK. And it sounds like, or the news is that she's pretty pro Bitcoin. So I just wanted to get you to give you a moment to chime in on that and give us some ideas to what you think about her and her relationship with Bitcoin. If you know anything about her whatsoever, I think it'd be great to kind of give the whole entire community a sense of what we can expect from her, and is this really good news for Bitcoin or not?
Yeah, that's great to hear. To be fair, I have some catching up to do. I am not across her kind of agenda and policies, so I probably can't really add any value on that point. But yeah, the more politicians we have that are pro Bitcoin or pro choice of currency and not necessarily government run money, I think the better, to progress away from the historic fiat manipulation we've seen. But yeah, unfortunately, I'm not up to speed enough on that to probably add any more value.
Charles, just on that, I know since you live in Germany, in Berlin, Germany's been surprisingly quite progressive when it comes to Bitcoin, to the extent that they're allowing, what do they call it, their special funds, their retirement savings accounts, to allocate up to 20% to Bitcoin or crypto in general. I'm not sure which one it was. Do you know much about that? Have you heard anything about that and what the view is in Germany?
Yeah, look, there has been some good progress. There's pros and it's Germany's a funny one. I suppose it's very ingenuitive and innovative in many regards, but they have this still history kind of ingrained, and it's hard to describe unless you've lived here, I suppose, of conservative in terms of money and especially inflation. So this time right now is quite interesting because they had that hyperinflation 50, 60, or whatever it is, 70 years ago, right? So it is front of mind, and control is of money and cash is quite front of mind. For example, in Berlin, half the places, they don't accept credit card. You have to pay in cash. I was like stepping back in time 10 years when I moved here.
I found that really odd when I went.
Yeah, but it's like that. It's weird kind of it's that mentality of control and trust and that sort of thing. So I think there's definitely some good innovation and progress happening there. At the end of the day, though, I must admit I do focus a lot more of my attention on financial developments in the US, because it does come back to that old saying that when the US sneezes, the world catches a cold, and when the Fed raises rates, the rest of the world basically follows. So a lot of my attention is more focused towards progress on the financial side there. But yeah, it is good to see that it's kind of progressing broadly.
Excellent. Gail, you're up next. Why don't you just unmute your mic and we are ready for you.
Yeah. Hi there. Can you hear me?
Yeah, go ahead.
Hi, Charles. Well, thanks for all. First of all, thanks for all the work you share. I think it's very valuable, very useful. And I just wanted to ask you just two questions. First of all, on the hash ribbons, which fired a buy signal, I was looking at the historical data, and I think the maximum drawdown has been around 15% in 2015. I think it's something you pointed out in your article, and we're currently around 8% and hovering around this important support level of 20K. So I was wondering, first of all, what do you think of the hash ribbon signal at present? If you think it's still reliable, something that we should give it importance, given how effective it's been in the past. And I guess the second question would be relating to M2 growth. I don't know if this is something that you've written about, but it seems like M2 growth is highly correlated with the Bitcoin price, which kind of makes sense. And currently we're seeing global M2 falling at quite a high rate. So do you think we need to wait until M2 growth starts entering positive territory before the Bitcoin price goes up again?
Can I just add my bit to Gail's question as well? Can you also give us some comments on the strength of the DXY as well?
Sure, I'll do my best on those three. So hash ribbons, we spoke about that quite a bit just before, so I'll keep it brief. But basically, I think it's still very relevant in terms of individual signal timing. Also, this one is in the second half of the halving cycle, which historically has been the best performing ones. That said, as we also discussed earlier, the miners, while powerful, they do have diminishing relative power within the network because we also have so many other institutions and players in the space. So I do think with time they become less powerful. The expected returns will probably reduce, but I am also actioning this signal personally. And as you mentioned, down draw. Again, this is not a complete strategy. The hash ribbons is a buy signal, so you have to work out your own exit or sell or risk management, etc. But down draw in the first sort of 1-2 month period is expected to be around 15, maybe a bit more percent. Some have had more, but that's around the average. So you can expect that. And as you said, we're around 6 to 8% now, so well within the normal range. M2 is another interesting one, and it's also a really logical one. Obviously, if the fiat money supply is going up, that is basically a sign of inflation and weakening value of currency. So it makes sense that Bitcoin would be quite correlated to that as the hardest digital asset. and work in reverse. So that is a valuable metric. The only thing with that is it's quite lagging. Don't quote me. I think it's updated monthly. I'm not sure, but usually you get signs from policy or the Fed or something which suggests a turn is happening, several months before you actually see it in that data. So you could argue that just the, as I mentioned earlier, the 10-year Treasury rate, as long as that doesn't break out a new high, it's kind of suggesting we're plateauing on that element at least, which that will probably line up. So yeah, I think it will be good to see some strength in M2 when that starts to, well, not good for the world, but I mean in terms of Bitcoin, if that starts to go up, then you could probably expect that Bitcoin will do quite well. But yeah, if you are willing to sit on your hands for a long time, or that could be a good strategy, or at least an additional point to consider. And then DXY, that's been an interesting one. I think particularly with all of this mess in Europe, that it's not surprising that it's rallying. Also, the EU has just been absolutely hopeless, I would say, in the first 6 months of the year in doing anything about inflation, and basically not raising rates for many, many months after the Fed. And then when they did it at an incredibly slow pace. So they're so far behind, and that just lack of action really caused the euro to plunge. I think it's about 15-20% or so. And obviously, if the euro is going down, the next obvious place for where Western capital flows is the US dollar. So the DXY has just rallied, and now you obviously have today Russia saying they're not going to send any oil and gas for the moment, at least, and that will obviously is expected to worsen the European economy, weaken the euro, and then the DXY keeps going up. But yeah, I feel like the upside is probably on the DXY. It's getting to the high level, I would say, because of things like everyone, like was mentioned at the beginning of the chat. There's a game of chicken happening with Russia and Europe and the US, etc. But the actions being taken are costing Russia incredibly. Like their oil and gas exports are 30% of their GDP to Europe. So if they turn that off, that's 30% gone. Yeah, they can redirect some to other countries, but building that infrastructure to pump that amount of oil and gas is a multi-year project. So I think, yeah, they can do it for some time. Obviously, depending on how crazy Putin is, it could be a long time, but it's a net losing action by both, by basically all parties. So the logical outcome is that this won't last forever, hopefully won't last for too long. And that's why I just feel like it's this max fear, max negativity in the world and doom and gloom sort of stuff happening, which I, generally have confidence in the good side of the world to prevail. So I do think that, hopefully the upside of DXY is relatively constrained.
Given how strong the correlation is to the DXY and M2 money supply, can you envisage a situation in which they don't move favorably for Bitcoin and yet Bitcoin still moves up? Or I guess, let me ask a direct question. Do you see Bitcoin breaking that correlation anytime soon?
Yeah, I can't put a time on it. I don't know if it's soon or later, but I do think there is a narrative misalignment right now with Bitcoin. Just by how poorly it's performed in high inflation, because basically the world, or most of the world, because we still have to remember that most of the world is not on board with crypto yet and Bitcoin. Most of them just see it as risk and speculation, right? In that bucket at least. So when things get scary, they dump Bitcoin, regardless of the fact that it was basically built for exactly this type of situation and inflation. And I think that's just a level of reflection of adoption and lack of understanding. Topics we sort of touched on at the beginning as well, with lack of understanding of what is the value of Bitcoin. And unless you've spent, days and weeks and really years in the space, it takes a long time to kind of work out what it is. So I do think that with time, it's that that narrative, that relationship will flip quite a bit, especially if inflation stays high for a long period of time. And inflation does tend to stick around in waves for many years. So, in the 70s, 80s, I think, it's 5, 6, 7 years type thing. And also in the sort of the 40s, I believe. So these situations can last for a while. And I think at some point, if the currency continues to devalue, or at least other currencies, right? Like the US dollar is going to be the strongest for the longest. But as you're seeing in Europe, right? Like the the euro is just being destroyed. All of these things, and it can take a long time, or it'll probably just kind of happen rapidly as well, like slowly, then all at once. But I do think it just all plays into exactly what Bitcoin does, and it was what it was built for. And so, yeah, I think ultimately that behavior will change, and I think it will do very well.
More and more people who have been in the markets for decades are starting to say that there's no way that the Fed can politically stomach what is required to bring inflation down to 2%, and that there may be, in fact, they may have to settle for what people call a new normal, an elevated level of inflation for some time, or between 4 or 5%, or whatever it may be, maybe 3, 5%. Well, do you have a view on that? And do you think that might be the catalyst for Bitcoin?
Yes. I don't think it'll ever be said, but yeah, basically yes. Because inflation's never a flat line either. It never just sits at 2% and goes horizontal. It's always in waves, and especially when it's high, like now. So those 2 periods I mentioned earlier, it might have gone to 10% or 15, and down to 0, and then back to 5, and then back to 0, then back to 10. And that's over, multiple year horizons. So I suspect, and I don't know how long and when it will happen, but once we see, say, 2, 3, maybe 4 months of reduced inflation, the Fed will probably soften their stance and say, look, we've got multiple data points to say it's under control, all good. Situation will ease a bit, but then maybe a year or 2 from there, it will just ramp back up again, or at least that's how it's behaved in the past. So unless we see really consistent aggressive action, that's my base case. But the Fed does have a history for flip-flopping and changing and being late and too early, etc. So that's kind of how I expect it to play out.
Charles, we've been going on just over an hour, and I'd like to congratulate you because we've pushed the price of Bitcoin up 0.81%. It was all our doing, I'm sure.
Very nice.
I really appreciate you coming on and giving us a great insight into what you do, what you think as well. Where can people find you on Twitter and online for any potential clients who want to get in touch with you as well?
Yeah, sure. So I'm on Twitter at Caprioli.io. And you can find our website at caprioli.com. And obviously on your page, the link's right at the top in this current Twitter space.
Yeah, so guys, if you want to find Charles, just go onto my profile and you will see that the Twitter space has tagged him. Click on that. Make sure you follow him. He's a really good follow. He's not tweeting incessantly. He's only tweeting when he has something valuable to say. So, you won't regret that follow. Thanks again, Charles. I really appreciate it, and I'd love to have you on sometime again. Thank you so much.
Great. It's great to be here. Thanks, Archie, and really enjoyed it. Happy to do it another time.
Looking forward to that. Thanks, mate. And thank you, everybody, for tuning in to another Spaces, and I'll see you all next time.
Bye, guys. Thanks for the good questions.